All right, good morning, everybody, and welcome to the ATBS Tax Cuts and Job Act conference call. I have to tell you, we've got a record number of attendees. We've never had so many people call into one of our conference calls through all the years of things that we've talked about. So I know there's a lot of people interested in this topic, and taxes sound really boring, but I think when we have the biggest tax reform we've had in decades, and it causes a lot of confusion. People are interested in getting good information. So we appreciate y'all being here. And I'm going to go through a lot of things related to the tax reform. But as I do that, I'm also going to talk about a few things and how this relates to trucking and how it relates to your business. I think this is, I've been around trucking for over 40 years, and I think this is maybe the most exciting time that I've been around trucking in the last 40 years. It's truly amazing what's going on and the opportunities that are out there for you all to be successful as owner operators in trucking. So I want to start off by just saying thanks to a couple of folks that work here at ATBS. Dan Prime, who's our general manager and a CPA, and Michael Schneider, who's an enrolled agent and oversees a bunch of our tax work. They spent a majority of their holidays and for sure the first part of this year pouring through this tax code and all these changes, because we all hear and see and read a lot of news articles that make a big deal of certain things. But, from a truck driver perspective, you don't really have any idea of what that means to you specifically. So our mission for Dan and Michael was to really comb through the 1,100 pages of tax reform and figure out exactly what it means to our clients so that we could, get together and talk with you folks and help you understand that exactly like we're doing here today. So again, thanks to those folks around ATBS who have been working super hard to get this information out to you. The second thing I want to tell you is just a couple of resources. We're going to talk through a lot of specifics today, but some of it may be confusing, and every single person is different from a tax perspective, so we may not touch on exactly the things that matter to you individually. So if you've got questions, I'm going to give you a couple of resources. Number one, hopefully all of you have received the ATBS ebook that is on the Tax Cuts and Jobs Act. If you have not gotten one, and if you do have one available or you're online, you might want to pull that up, because a lot of the stuff we're going to talk to is in that ebook, and you'll be able to see some specific examples. If you haven't gotten that ebook, simply go to our website, atbs.com, and there's a button there you can click to download a copy of that ebook. And it's, I don't know, about 18 pages, and it'll go through a lot of the stuff we're going to talk about today. The last thing as a resource I'll give you is just our phone number here at ATBS. It's 866-920-9827. Again, it's 866-920-ATBS. And you can call that phone number. A lot of you on the call are current clients, and you can simply call your business consultant. We spent the last few weeks training all of our staff here at ATBS on the tax reform and what it means, and so they can go through your individual questions and situations and help you. I know this conference call has been broadcast on the radio and in some trade magazines and those kinds of things. So maybe some of you on the call are not ATBS clients. Feel free to call that number as well. And we've got folks that can help you figure out your specific tax situation after this tax reform bill. So we sent out a couple of emails in the last few days asking for questions, because we wanted to make sure it's impossible, with so many people on the line, to take questions live. So we asked for questions via email that y'all were concerned about, so that we can make sure we're going to address those. And we kind of lumped them into categories. And so I just want to touch on kind of the things that everybody had questions about and kind of most misunderstood pieces of the tax law as we've had this tax reform. The first, and it's always something that's a topic of conversation, is per diem, and understanding exactly what happened to per diem and what per diem is going forward. So we'll spend some time talking about per diem for sure. The second is health insurance. The news talks a lot about this Trump tax law, get away with Obamacare, and you no longer have to pay your penalties. So we're going to talk specifically about the details around that. The third thing is a lot of questions around corporate structure. As an owner operator, do I need to change the type of entity that I am to take advantage of the new tax law? We'll talk about that for sure. The fourth thing is depreciation. There's been a lot of change to the depreciation laws. Depreciation is confusing to begin with, so we'll talk about what that means to you. And the last thing, one of the questions we had, which is always a confusing point for a lot of our clients is a home office deduction. So we'll talk about that as well. So, with that, I'm going to kind of get started with the content and start getting into some specifics. Just to kind of set the stage, you've probably heard, read, seen on the news, this is the largest tax code overall since the early 1980s. It seems like every time we get a change in administrations, whether we go from Republican to Democrat or Democrat to Republican, they might tweak some tax rates here and there, and they might do a few things related to the taxes. But as far as an overall of the tax code, we haven't had one of these in over 35 years that's this significant. From a high level, I'll give you kind of maybe the good news and the bad news. The good news for the owner operators on the phone, we've run a bunch of samples and calculations and examples, and we believe that the average owner operator making net about $60,000 a year is going to save around $2,000 as a result of the tax changes. I'll get into some specifics and tell you, where that calculation comes from. But that's good news. The average owner operator will pay $8,000 to $10,000 in taxes, so that's almost a 20% tax cut for the average owner operator, which is fantastic. The bad news is if you're a company driver, and I'll just say that your per diem deduction is going away as an itemized deduction, that could mean that your taxes are going to go up by almost $600 as a company driver. So this could be a hit for company drivers, but hopefully we can help you understand that and help you to make sure that that doesn't happen as we go through the presentation. One other thing I just want to touch on before we get started is a lot of what you heard was their goal was to simplify the tax code. And in my mind, anytime you write 1,100 pages to revise something, you probably didn't simplify it. If you simplified it, you probably got rid of 1,100 pages, not added 1,100 pages. And so what I'll say is overall, there's been a significant amount of complexity added to the tax code. But there are a few things that have gotten simpler, and we'll kind of touch on each of those as we go through this. So the first thing I'm going to start off talking about, and just so you understand, if you're listening in on the call, this is predominantly an owner-operator based study and analysis of the tax code. There's going to for sure be some things in here for company drivers, but one of the biggest, most confusing things that came out of this tax overall is something called a pass-through entity qualified income business deduction. And let me just kind of start off with the big picture of what that is and why they did it. You heard again through the news and the administration and Congress and everybody else, the biggest reason that they said they needed to do this tax overhaul was because we had an unfair corporate tax rate at 35%. And they said American corporations are unfairly advantaged. And that's why all of our jobs have moved overseas. That's why we have large American corporations that have trillions of dollars in foreign bank accounts, because it costs too much money for them, or too much in taxes for them to bring that money back to America. So they wanted to lower the corporate income tax rate, and they did that. The foundation of the tax bill was going from a 35% tax rate to a 21% tax rate for large corporations, C corps in America. That's maybe the biggest thing we've heard talked about related to this tax bill, and that's also somewhat why you heard this is a big company, rich people tax cut, and that's not exactly true. It's for sure going to help those big corporations pay less taxes, but ultimately what that really meant is if they do that just for the big corporations, number one, all the rest of us are going to be really mad because they gave big company rich people tax cuts and none of the rest of us got one. But really in simple terms, what it means is most of the jobs and businesses in America are small companies just like you. They're individual small business owners, owner operators. And so what they wanted to do is be fair, because if they didn't change the tax code for us small business owners, we would all think now we got to convert to a C corp to take advantage of those lower tax rates. So what they did is created something that's really confusing. And in the early days, back in November, you had the House and the Senate kind of arguing over this, and the House had it pretty simple. They just wanted to lower the tax rate for small businesses to the same thing, about 20 to 23%, and that sounded pretty simple. For some reason, the Senate decided they needed a more sophisticated plan, and they created this pass-through entity qualified business income deduction of 20%. And that's what got settled on and what got put into law. So let me help you understand what that means in simple terms. And one thing that I think is really important, because one of the biggest questions we get is, do I have to change the type of business I am to take advantage of this? The simple answer is no. You can be a sole proprietor, you can be a partnership, you can be an LLC, you can be an S corp. each one of those entities gets qualified as a pass-through entity that can take this qualified business income deduction. So that's really important for you to know. So if I just give you a simple example, let's just take our average owner operator and say you do $150,000 a year in revenue, you have $90,000 in expenses, things like maintenance, fuel, all those kinds of things. And so that means your net income is $60,000. What this qualified business income deduction says is that I can take an additional 20% deduction off of my net income. So I take that $60,000 times 20%, and I get an additional deduction of $12,000. That gets my net income down to $48,000. So it lowers my taxable net income. So working with those numbers, a lot of people have run those numbers and done the simple math in their mind to say, well, gosh, the average owner operator, might pay 30% in taxes. If he's saving $12,000 with this deduction, it's going to save him from $3,500 to $4,000 in taxes. That number is over calculated because it's too simple. There's a lot of details that have to go in to kind of get down to the bottom line number. And as I said in the beginning, we think it's about $2,000 for the average owner operator. So it's about half of that simple calculation. But again, I just kind of wanted to lay out at a high level what this pass-through entity qualified business income deduction is for you, because bottom line is it's a great thing and it's going to reduce your taxes. So if you're looking at the ebook, I'm going to try and keep this simple on the phone because it's hard to talk through a lot of numbers and have people follow along. But if you're in the ebook and you're looking through it, I'm going to be talking through table 1, 2, and 3. And those are tables that are put together. Table number 1 was put together to kind of look at income tax perspective from the entity perspective. And then table 2 is more from the individual income perspective. And then table 3 is what really ties all those together and gets down to the tax level and helps you understand what you're going to pay from a tax perspective. So I said a little bit ago that it doesn't matter. You get this qualified business income deduction no matter what structure you are. But one of the important things we think every owner operator needs to do at this point is really think about how they're positioned to take advantage of the tax bill. And so as we put together these table 1, 2, and 3, what we really did was try and calculate and demonstrate the lowest tax structure you can have as an owner operator. And when you get to the bottom line in table 3, essentially the difference is if I'm a sole proprietor, my tax bill with this qualified business income deduction, everything taken into account from a business perspective, none of the personal stuff, but just the business perspective, I'm going to pay $9,353 in taxes. If I'm an S corporation, I'm being taxed as an S corporation, I'm going to pay $6,704 in taxes. So the difference is right around $2,600. I can save $2,600 in taxes by being an S corp versus a sole proprietor. And again, I'm not here to tell you that because of the tax bill, you should instantly go out and change your business structure and everybody become S corps tomorrow. I just want you to help you understand the math. And really, the big tax advantage of being an S corp, and this is not necessarily a result of this tax bill. The big advantage is if I'm an S corp, I can set myself as an employee under my S corp, and I can pay myself a lower wage than I'm taxed on as a sole proprietor. So I got to pay myself a reasonable wage, and let's just call that about $40,000 for the average company driver. So I can pay myself that out of the S corp. But if I really did make $60,000, I'm saving self-employment taxes of 15% on the difference between what my company made and the wage I paid myself. And that's really where that $2,600 comes from. And so in the end, it gets a bit more complicated because now I'm an S corp. I got to do a corporate tax return. I actually have to do payroll for myself, and I got to do withholdings as an employee and remit taxes to the government. So it gets more complicated. At ATBS, we've got a premium service that will do all that for you. We can incorporate you. We can do your payroll. We can do your S corp return. But it costs more money. And so the bottom line is you got to weigh what I'm going to save in taxes versus what I'm going to pay, to have a more complicated business structure. So really the most important thing is if you're pretty new in this business, you're a relatively new owner operator, you're not quite sure what your income is going to be, this year and the next couple of years, you're probably best off being a sole proprietor, getting your feet on the ground, running your business and doing the best you can. If you've been at it for a while and you know that you make over $60,000 every year and you forecast to do that going forward, it makes all the sense in the world to set up an S corp and save some money on taxes. And again, you can give us a call and we can help talk you through the exact numbers from your specific, individual circumstances. So hopefully that made sense, because that's one of the most confusing things relating to this new tax code, is that qualified business income deduction of 20%. But it truly is a tax break for small business owners, and it's a great thing that you get to take advantage of. So I'm going to move next to talking about depreciation and Section 179 deduction. This stuff is really confusing, and even for people that are CPAs and tax accountants, you've heard of things like makers and accelerated depreciation and bonus depreciation, and there's a lot of the tax code. A ton of pages are dedicated to how you depreciate assets. I'll start off real simple and just say that the new tax code, the beautiful thing about it is it made it simple, and it said whatever we buy in a year, we get to expense that year. It used to be if I bought a truck, it was depreciated over 3 years. And so in simple terms, I'm going to say I bought a $90,000 truck. I would deduct $30,000 of that truck each year. So 30,000 year one, 30,000 year two, 30,000 year three against my income. What happens today is that entire truck is depreciated in the first year and written off as an expense. So anything that you buy, from a laptop computer to an iPad to an APU for your truck to a truck or a trailer, gets expensed in the first year. The good news is this goes back to September 27th of 2017. So if you bought something in the fourth quarter of last year, you can also do this. This was put into place all the way through 2022. So really, for the next 4 years, you get to take advantage of this break, and then it starts scaling itself back 20% a year, and we get back to the old tax law. But for the next 4 years, really what you need to understand, and I'll just give you a simple example. If I go out and buy a brand new truck and a brand new trailer today, let's just say that cost me $150,000 for a new truck and $100,000 because I buy a really nice, trailer. I'm in a little bit of a specialized haul. So I spent $250,000 on a truck and a trailer. I'm going to expense that all in 2018. So if I'm the average owner operator making $60,000, I just had a truck and trailer expense of $250,000. That means my net income is down to losing $190,000. The good news about that is there used to be rules on how long I could carry a loss forward. The new tax law, I can carry losses forward indefinitely. And so I'm going to have a loss this year. I'm not going to pay any income tax, and I'm going to have a loss if I'm making $60,000 a year for the 3 years after that. For literally the next 4 years, I'm not going to pay any income taxes. So it's a good thing that we get to expense those assets. And as I talk about the economy a little bit, and what this means, this also is the case for big corporations. When they buy billions of dollars of assets, they're going to get expensed. And so what that means is they're not going to pay any taxes this year. They're going to use that money they don't pay in taxes to reinvest. So if you work for a big truck line, even though you're not an operator leased onto that truck line, they may increase their truck purchasing this year because they can offset their income and upgrade their fleet with new trucks. When all that happens, it means our economy revs up because we got to produce all these assets that people are going to buy because they can now expense them in the first year rather than have to depreciate them over a period of time. So along with depreciation, I just want to talk about Section 179. It's something that you probably have heard about. It's probably been on your tax return before if you have been an owner-operator. There used to be kind of a specialized rule called Section 179 that allowed owner-operators to deduct a certain amount. There were limits, $500,000 last year on the assets that could be deducted. That was raised to $1 million. And really, probably the most important thing that you need to know is you don't need to use Section 179 anymore. It was a tool that we could use for small business owner operators to help get some accelerated depreciation and write off those assets earlier. And with these new depreciation rules, we don't have to worry about Section 179 anymore. So another thing that kind of falls under this category is what's called a like-kind exchange, often referred to as a 1031 exchange. And that has been eliminated under the new tax code. And really what that means is trading one asset for another and reducing my gain on getting rid of an old asset. So that's been eliminated except for real estate. If you trade real estate, you can still do a 1031 like-kind exchange. So again, let me give you a little bit of an example and help you understand what this means from a trucking perspective. Let's just say I've got a 5-6 year old truck, and now that I hear these new rules, they sound pretty good, and I want to go buy myself a new truck because I get to write it off in year one. So let's just say my old truck is worth $50,000 and my new truck's going to cost me $150,000. What happened in the old days was I would simply go to a dealer and I'd make a deal and I'd trade in my old truck for a new truck, and my net would be $100,000. They'd give me 50 grand for my old one. I'd pay 150 for the new one. Cost me $100,000. So what would happen is I would offset what probably was the case is my old truck, I had depreciated down to zero under accelerated depreciation. When I sold it for $50,000, I'd have to pay a gain on selling it because I'm, gaining money from an asset I'm selling. If I did a like kind exchange and traded it for a new truck, that didn't happen. I didn't have to pay that gain. I just got a new basis in my new truck of $100,000 and I didn't have any tax consequences. What happens in the new world going forward is we're going to have to show that you sold that $50,000 truck and you're going to have to recapture the depreciation and show a gain, which is taxable. But the good news is with the new rules, having depreciation all in the first year, expensing your truck in the first year, the $150,000 truck, the net is really the same. I get back to where I started and I have a $100,000 net value new truck. So the good news is even though you hear a lot of scary things like, the like kind exchange has gone away, the net effect should be $0 to you. So those things are kind of, a high level business look, a lot of the stuff that involves your business and kind of being an owner operator and the tax changes as far as that goes. Next, I'm going to get into kind of more of the personal side, and we're going to talk about deductions, exemptions, and tax credits. And those are things that happen whether I'm a company driver or an owner operator, or, really they affect everybody in America. And so I'm going to start off by talking about the standard deduction. And for those of you that don't know what the standard deduction is, it's just simply the IRS allows you to deduct a certain amount off of your income before your taxes are calculated. Just that's the way the deal has worked and the way it always has. So I'm going to give you different categories. We're going to start off with married filing joint. So if you got a spouse and you guys filed a joint return, under the old law last year, that standard deduction was $12,700. That standard deduction was doubled going forward. So it's $24,000. If I'm married and I file a joint return, I get to take a $24,000 standard deduction. If I'm single, not married, and I just filed my own tax return, that standard deduction went from $6,350 last year to $12,000 this year. If I file as a head of household, it went from $9,350 to $18,000. So in almost all cases, it doubled. So this is one of those places where I said, even though there's 1,100 pages of new tax code, this is one of those places they really did simplify the tax code. And I believe the reason they did it is because there was a lot of gamesmanship and a lot of fake numbers, but also kind of a pain in the butt for a lot of people that had to track a lot of things and itemize on the Schedule A if they were above that standard deduction. I think the way, Congress and Donald Trump looked at it was if we raise that standard deduction enough, then we take care of most people. They don't have to itemize all these things and worry about all these things. And a lot of people that cheat on all these things, let's just take that off the table and raise that standard deduction enough so that argument simply goes away. So when you hear about things like charitable deductions gone away, I can't deduct the interest on my house anymore, I can't deduct property taxes and all those kinds of things, in some sense, it's true. A lot of those things are taken away, but the reason they're taken away is because going from a $12,000 to $24,000 standard deduction, I don't need to deduct those things anyways. Even if I did, I would fall under the amount of that standard deduction, so I wouldn't itemize anyways. This is a place that the per diem is affected, which I'm going to talk about in a minute, but this is why the company driver loses their per diem deduction. And again, I'll get into details on per diem in a minute. So I want to go next from the standard deduction to talk about credits. And important things to understand about the different terminology when it relates to taxes. Credits are the most important word that you can hear. Sometimes if you don't make a lot of money, you hear earned income credit. You get money back if you don't make a lot of money and you file a tax return. I'm going to talk about a child tax credit for a minute because this is something that they increase and it's truly valuable. The reason I say that you want to perk up when you hear the word credit is because it's the best thing you can get. It's a dollar for dollar offset against your tax. And so in simple terms, if I owe $10,000 in taxes, if I get a $500 credit, it dollar for dollar reduces my tax bill to $9,500. So again, let me give you an example of what that means. Under this child tax credit, essentially what happened is last year I had $1,000 for every qualifying child that I had in this tax credit. They doubled that this year, and going forward, it's $2,000. So that's a pretty big deal. And what's even a more big deal is $1,400 of that credit is refundable. So let me give you a real life example. Let's just say that I owe $10,000 in taxes. That's my net tax liability. And let's say that I have 4 kids, and that tax credit, as you heard, is $2,000. That means I'm going to get an $8,000 credit against my tax bill. So my tax bill goes from $10,000 minus the $8,000 credit down to a net $2,000. Again, a dollar for dollar offset. The even better news is if you don't make a lot of money, well, let's just say you went out and bought a new truck and you expense that whole truck this year and you got your net income to zero, but you still have those 4 kids, you get that $2,000 credit, but $1,400 of that credit is refundable. So 1,400 times 4 is $5,600. So you actually are going to get a tax refund, even though you didn't pay taxes because you're zero. You're going to get a tax refund of $5,600. So that child tax credit is a big deal, and a great thing if you have kids. The offset to that is what's called an exemption. So last year we had something called a personal exemption. For every kid that I had, I could take a personal exemption of $4,050. Those personal exemptions are wiped out this year. I don't get an exemption. So again, an exemption is not like a credit. A credit is offset against my tax bill. An exemption is offset against my income. So really what that meant is if I had 4 kids times that $4,000, I could take $16,000 off my income last year to calculate my taxes. So that went away. Bottom line is when you kind of match those two together, getting rid of that $4,000 exemption, but increasing the credit by $1,000 is almost an equal offset. So bottom line is it should be simpler. And the even better news is I didn't get, if I went below zero on my net income with exemptions, I didn't get a refund. With the tax credit, I actually get a refund of up to $1,400 per child. So hopefully that makes sense. It's a good deal if you have kids. Next, I'm going to talk about simple tax deductions, and I'm going to go back to say that these really matter if you're an itemized filer and you file a Schedule A. And so for most people, that goes away. This is no longer a concern because if I'm married, I have to have these deductions amount to over $24,000 before I worry about them, and I'm going to itemize them. For almost every client we have, that's not going to be the case, and you're just going to simply take that $24,000 standard deduction. If I talk about these individually, we talk about medical expenses. Under the old law, I had to go over 10% of my adjusted gross income. So if I made $60,000, I had to have over $6,000 of income of medical expenses before I could deduct any medical expenses. They changed that to 7.5%, so they lowered it a little bit, so I can maybe deduct a little bit more medical expenses this year. State, local, and property taxes, those used to be 100% deductible. Whatever you paid on your personal automobile, your home, all those taxes were deductible. Those were reduced, and only up to $10,000 of that can be deductible going forward. I don't know a lot of our clients that have property taxes in excess of $10,000. So again, shouldn't be a big deal for our clients. And those of you on the phone, mortgage interest, you heard a big deal made over this. They were eliminating mortgage interest. In the end, what they did was went down to $750,000. That's the maximum mortgage you can have to claim interest expense. And again, most of our clients don't have $750,000 mortgages, so it's not a big deal for our clients. A lot of these are expenses that are going to affect the rich. They actually are going to, increase the tax on the rich people. One that affects a lot of people is moving expenses. The moving expense deduction was eliminated. I can no longer take a moving expense deduction unless I'm in the armed forces. So if you have a relative or know somebody that's in the armed forces, they can still deduct moving expenses. The last I'm going to talk about are a big deal for everybody on the phone. The first one is income tax preparation fees. Used to be, no matter who I was, I could deduct my income tax preparation fees. That's been eliminated. I can no longer itemize that on my Schedule A. And so company drivers can no longer deduct income tax fees that maybe they pay ATBS, maybe they buy off the shelf software, whatever it is. That's not deductible anymore. The good news is for owner operators, a fee like an ATBS fee where we do your accounting and your taxes is a necessary and ordinary business expense. And so that can still be deducted as a business expense on your Schedule C in your business. And so even though you hear the news that income tax preparation fees have been eliminated, that's not the case for you as an owner operator doing business with ATBS. You can still deduct our fees. So now we're going to get to the category that is called unreimbursed employee expenses. And this is where per diem falls under. So essentially what they said is any non-reimbursed employee expenses can no longer be itemized and deducted. And so let me talk you through what that means from an employee perspective, which means I'm a company driver to truck line. What used to happen is if I drove for a truck line and I was away from home, the IRS allows me to deduct my meals expense away from the time that I'm on the road, $63 a day. And if I didn't have a per diem deal with my truck line and they just didn't pay me that, I could itemize that deduction on my Schedule A. And typically that's a $15,000 deduction. The average owner operator, I'm sorry, the average driver being away for 285 days times $63. And then you can deduct 80% of that on your Schedule A. So it gets to be about a $12,000 deduction. They eliminated that. And so let me just stick with company drivers for a minute. Really what that means is I no longer get the benefit. So if I got a decent refund at the end of the year because I took a per diem deduction, that's gone. And that's why we say the average company driver's income tax is going to go up by $600 because that per diem deduction is disallowed for company drivers. The way around that, if you're a company driver, is to find a company that pays per diem pay. And let me just give you a quick example of that. Let's just say the average company pays you as a company driver 40 cents a mile. They may have an option to take per diem pay, and they're going to pay you less under per diem pay. They may pay you 30 cents a mile for regular pay, and they may pay you 8 cents a mile for per diem pay. So even though it sounds like you're getting less money, unless it's more than a 2-cent differential, you always want to take the per diem pay option going forward. The reason is because that 8 cents a mile that they're paying you for per diem pay, they can still deduct as an employee expense. They're reimbursing you for your meals on the road. And what that means is they don't have to withhold tax for you because you don't have to pay taxes on that. They don't have to pay your employee taxes. You don't have to pay Social Security on that. And so that is today the only way that a company driver can take advantage is through a company of that per diem expense. I know most of you on the call are owner operators, and so let me explain what this means to you as an owner operator. The good news is the deduction is still there. Meals and incidental expenses are still a necessary and ordinary business expense for you when you're away from home. You can't eat cheaply, by going to your fridge and your microwave and the grocery store when you're on the road. So the IRS still allows you to take that $63 per day deduction every day you're away from home. You can itemize that on your Schedule C. So again, it's the difference of being an employee versus owning your own business. On a Schedule C, you can itemize that deduction. So the bottom line is the per diem deduction did not go away for owner operators, but it did go away for company drivers. Hopefully that makes sense. I know it's super confusing and we always have a lot of questions on per diem. If not, like I said, give us a call here at ATBS and we can talk you through the details of that. So I'm going to move to a couple of more specific deductions. Alimony and child support, and this is going to sound a little bit like a joke and a little bit flippant, but if you're not getting along with your spouse, get divorced by the end of the year. And the reason I say that is because after December 31st of 2018, alimony payments will not be deductible by the person that's paying them. So under the old law, really what happened, and even still in 2018, if I have, an alimony payment by law, by the court that I need to pay to my ex-spouse of $1,000 a month, I can deduct that off my taxes under the old law. My spouse has to claim that as income. Going forward after December 31st, 2018, that goes away. The important thing to know is if I've got that divorce settlement filed and it's, in place before December 31st of 2018, then everything stays the same. I still get to deduct that. Another important thing to remember is if I have a divorce decree in place, but I go change it after December 31st of 2018, they take that deduction away again. So if you have something you got to deal with like that, you'd be smart to take care of it before the end of the year. Child support has never been deductible, and that didn't change. It's not deductible. Another important thing that a lot of people are confused on is the Affordable Care Act. And you hear, news and you hear people saying, I don't have to pay my Obamacare penalty anymore. I don't have health insurance, but I don't have to pay the penalty. So, that is the case. The unfortunate part is it doesn't take effect until January 1st of 2019. So if you did not have health insurance in 2017 and you're in the middle of filing your tax return, you're going to be subject to that Obamacare penalty. At the same time, if you don't have health insurance this year in 2018, you're also going to be subject to that Obamacare penalty. It doesn't go away until 2019. The average penalty, and it's, there's a lot of rules around it. We have to file multiple pages with every tax return to calculate this. But if you don't have that, depending on your dependents, your income, all those kinds of things, that penalty can range anywhere from $600 to $2,000. So it's pretty significant. So again, the Obamacare penalty does not go away until 2019. So really, one of the last things I'm going to talk about is overall income tax rates. And if you're following along in the ebook, we're near the end, and we're going to get into the tax brackets and rates section. There's a few tables in there. So the general rule that I'm going to say is the good news is in the income category that most of our clients are in, around $60,000 for the average owner or operator. The good news is the tax rates went down on average by about 3%. And so you're going to see a tax savings, of some examples. The first thing that I want to talk about is single taxpayers for 2018. So I'm not married, I'm just doing my own tax return. And the category that most of you are in is $38,700 to $82,500. The tax rates went from 25% down to 22%. So as I said, the good news is my tax rate was reduced by 3% if I'm a single taxpayer in that category. If you're looking at those tables, something that's really important to understand is you see that the tax rates jump. If I make $38,700, my tax rate is 12%. If I make $38,701, my tax rate goes to 22%. A lot of people kind of get confused over that, and they think, man, if I go make another $10, my tax rate is going to jump by 10%. The important thing you got to realize is this is a scaled tax rate, and so really the way it works is on the first $9,525 I make, I pay taxes of 10%. For the next, from 9,525 to 38,700, I pay a 12% tax rate, and over that, I'm going to pay a 22% tax rate. So when you kind of average all those together, the average owner operator tax rate just for income tax is going to be somewhere around 15 to 20%. So I'm going to skip over head of household because we don't have a ton of filers that file as head of household, and I'm going to go to married couples because we have plenty of people that file married. So what the rules are for married is if I make between $19,000 and $50 and $77,400, so that's the category most of our owner operators fall into, the average income tax rate went from 15% to 12%. So again, a 3% reduction. But the good news is there's a lot lower tax rate for you if you're married and your spouse doesn't work, and you fall, in that $60,000 average net income rate. So that's all I'm going to say really about tax brackets, other than you hear on the news that your pay should go up in February. Your net paycheck should go up in February. And let me just kind of explain why that is. When they settled all this tax code and got the law put into place right before Christmas, there's, like I said, 1,100 pages that now have to be implemented. And so it takes all of January for the IRS to sit down and redo withholdings tables and send them out to your company if you're a company driver and, figure out what all those numbers are. You also heard a little bit of news over the weekend when the government shutdown was, hey, we're not going to get these withholding tables done and these people aren't going to get better paychecks. And that's all politics. The bottom line is, by February, your company should have the lower tax rates and more withholdings. And if you're a company driver, you might see a $20 to $30 per week pay increase because your tax rates are going to be less. From an owner operator perspective, what that means is your estimated tax payments are going to go down. So at ATBS, when we calculate your estimated taxes, which the first quarter is due April 15th, that's going to be lower than it was, April of last year because of the lower tax rates. So either way, owner operator, company driver, the good news is you're going to have lower withholdings or lower estimated tax rates, which is a good thing. So if you're following along in the ebook, I'm near the last page and there's a big long table in there that I'm going to try and talk through and make simple for those of you that are just listening in on the phone. Our goal in the table was really to try and help you see the tax liability change between 2017 and 18 for every category that you could operate in, whether I'm a company driver or I'm an owner operator, and if I'm an owner operator, different corporate structures. So I'm going to just kind of talk you through that from left to right. If I'm a company driver, my tax liability, if I'm a single, and we list single and married filing jointly on this table, but I'm just going to talk through me filing as a single individual. If I'm a company driver, my 2017 tax liability was around $7,113. My 2018 tax liability is going to be $7,700. So that's a $600 increase. We already talked about why that is because of the per diem going away. If I work for a company that I can do the per diem pay structure, just a simple calculation, my taxes are actually going to go down by about $1,000. But again, I got to make sure I'm under that per diem pay structure with the company that I'm driving for. So next we get to the owner operator that's a sole proprietor, which is about what 95% of our clients are. They just run their business as an individual and file a Schedule C as a sole proprietor. In 2017, my average tax liability was going to be $11,447. In 2018, my average tax liability is going to be $9,353. So I'm going to save $2,000 in taxes just because of that qualified business income deduction and tax rates going down. So that's good news. I pay $2,000 less in taxes. If I'm an S corp, in 2017, my tax liability was $7,775. In 2018, my tax liability is $6,700. So my rates are going to go down by $1,000 as an S corp. And we have a C corp just listed for 2018 on the far right-hand side. The tax liability for 2018 is $10,900. We put that down there just to help demonstrate that it almost never makes sense for an individual owner operator, even if I've got 15 or 20 trucks, to be a C corp. And the reason that is because I get double taxed when I take money out of my company. If I distribute it as a dividend, I've got to pay a tax. I don't have to do that as an S corp or a sole proprietor. So, just to tie that out one more time, I want to walk through all the 2018 rates. The single lowest amount of income tax that's going to be paid is by an owner operator that's an S corp. They're going to pay about $6,700 in taxes. If I'm a C corp, I'm going to pay $10,900. If I'm a sole proprietor, I'm going to pay $9,300. So that goes back to that example we did early on where I'm going to save $2,600 if I set up an S corp and pay myself a wage. That's the lowest tax structure there is. Again, as a company driver, I'm going to pay $7,700. So it's higher than that S corp owner operator. Again, I know that's a ton of numbers, and I apologize if it's confusing. You can look at the ebook, and you can also give us a call here, and we can talk you through it. So really what I want to wrap up with is just kind of talk through some of the high-level stuff that we've been through. Number one, the good news is this is a tax reduction for just about everybody. Company drivers, we get that issue with per diem. Hopefully you can get that figured out with the company that you drive for. But for owner operators, for the average American, and also for big corporations, this is a tax reduction for everybody. The average owner operator is going to pay about $2,000 less in taxes. The average company driver could pay $600 more, or they could get a $1,000 tax break, depending on how they figure out their per diem with the company they're working for. What I think is most important for everybody on the phone beyond taxes, and hopefully we've cleared up a bunch of tax stuff for you, but I think what's most important, and what at ATBS is, we try and always keep you, appraised of what's going on in the industry. What these taxes really mean is there's going to be a boom in the U.S. economy. You've already seen the stock market go to record highs almost every day since this past. You've heard GDP is going to go from under 2% the last 8 years to over 4% probably next year. All that is a result of a really hot economy, things that are really good. But a lot of it is a result of what I talked about earlier. With that depreciation rules, there's going to be a lot of people out buying a lot of stuff. People are going to feel better as they pay less taxes, that they have more income. They're going to go out and start shopping more. All that means more things start getting shipped. At the same time, I know a huge topic of conversation has been this ELD over the last month since it got implemented. And I know a lot of you on the phone, might be pissed off about the ELD. But what you really got to understand is the bottom line is if you figured out how to operate with an ELD in this market, there's more freight than there is trucks. There's literally freight sitting on docks, not getting moved. What that means is rates go up significantly, substantially, and it's going to be sustainable. It's not something that's here for the next 3 or 4 months. I believe this can happen for the next couple of years. So kind of goes back to what I started off the phone call with. There's never been a better time to be an owner operator in the trucking industry. You should be able to make more money and pay less taxes over the next couple of years than you ever have being in this business in history. So it's a great time. I hope you're optimistic. I hope you're seeing it and experiencing it. And if you're not, something's not going right in your business, and you need to give us a call so we can help get you situated in the right way, because it's truly the best time it's ever been to be an owner operator in trucking. So I apologize we can't take individual calls. Hopefully we've answered most of your questions. If not, feel free to give us a yell. I'll give you, again, our website is atbs.com. Our phone number is 866-920-9827. With that, I'm going to wrap up the call and just wish you all safe driving, and God bless. Take care. Good luck this year and have a great 2018. Thank you.